Imagine you are standing in front of a powerful machine. This machine represents a real company. It has employees, factories, software, customers, debts, and dreams. It produces products, generates revenue, and spends money. Now someone asks you a simple but serious question. What is this entire machine truly worth today? Not what the headlines say, not what the market feels this morning, but what is the business fundamentally worth based on the cash it can generate in the future? This is where valuation moves from philosophy to precision. In the first part, we explored why value matters and what creates it. We learned that value comes from earning returns higher than the cost of capital. We understood that growth only creates value under the right conditions. We saw that markets reflect expectations about future performance. Now the question becomes practical. How do we actually measure all of this? Many people think valuation is guessing. Others think it is complex mathematics that only experts understand. In reality, valuation is structured thinking. It is about organizing information, asking the right questions, and connecting performance to future cash flow. Valuation begins by looking clearly at the business. Financial statements must be reorganized to separate operating activities from financing choices. Performance must be analyzed to understand margins, capital efficiency, and growth patterns. History gives us clues, but it does not give us answers. Then comes forecasting. We estimate how revenue might grow. We consider how costs may change. We think about how much capital the company must invest to support growth. Every assumption must be realistic and internally consistent. But even after forecasting several years, the story is not finished. Most of a company's value often comes from the years far into the future. This is why estimating continuing value becomes so important. It forces us to think about sustainability, competition, and long-term stability. At the same time, we must measure risk carefully. The cost of capital reflects the return investors expect for taking risk. If we underestimate risk, we overestimate value. If we overestimate risk, we undervalue strong businesses. Once enterprise value is calculated, we move toward equity value and finally value per share. But the process does not end with a single number. Good valuation requires analyzing the results. We test different assumptions. We ask what truly drives the outcome. We compare our findings with market prices and multiples. Multiples provide quick perspective. Valuation by parts helps when companies operate in different businesses. Each technique supports the main framework. None replaces disciplined thinking. This part of the book provides the tools. It turns principles into practice. It shows that valuation is not magic. It is a logical sequence of steps built on economic reality. Before we calculate anything, however, we need a clear structure. We need a framework that connects business performance to value in a consistent way. That is where this section begins. The journey into practical valuation starts with one essential question. What framework should we use to value a company correctly? This leads directly into the first chapter of this part. Frameworks for Valuation. Chapter 10. Frameworks for Valuation. Imagine two investors looking at the same company. Both read the annual report. Both see the same revenue, the same profit, the same growth rate. Yet one believes the company is expensive, and the other believes it is a great opportunity. Why does this happen? The difference is not only opinion. The difference is framework. A framework is a structured way of thinking. It is a map that guides how we move from information to conclusion. Without a framework, valuation becomes scattered. With a framework, valuation becomes disciplined and repeatable. At its heart, valuation answers one question. How much future cash will this business generate, and what is that cash worth today? Everything else supports this central idea. There are many ways people attempt to value companies. Some rely only on accounting profit, some focus only on earnings per share. Some compare price multiples without deeper analysis. These shortcuts may feel convenient, but they can mislead. The most reliable framework begins with cash flow. A company creates value by generating cash that can be distributed to investors or reinvested at attractive returns. Accounting profit can be influenced by non-cash items, policies, and timing differences. Cash flow is harder to manipulate and closer to economic reality. The core framework used in modern finance is discounted cash flow. The logic is simple. Money received in the future is worth less than money received today. Therefore, future cash must be adjusted to reflect time and risk. When we estimate all expected future cash flows and bring them back to today using the cost of capital, we arrive at enterprise value. This framework forces clarity. It requires explicit assumptions about growth, margins, investment, and risk. It makes the driver of value visible. It connects strategy directly to financial outcome. However, discounted cash flow is not just a formula. It is a way of organizing thinking. It requires understanding the economics of the business. What drives revenue growth? What determines operating margins? How much capital is needed to support expansion? How sustainable are returns on invested capital? A strong framework separates operating decisions from financing decisions. Operating performance determines how efficiently the company creates value. Financing decisions determine how that value is distributed between debt holders and equity holders. Mixing the two can create confusion. This is why enterprise value is calculated first. Enterprise value reflects the value of operations independent of capital structure. Only after determining enterprise value do we adjust for debt and other claims to arrive at equity value. Another important element of the framework is consistency. Assumptions about growth must align with assumptions about investment. If revenue grows rapidly, additional capital is usually required. Ignoring this link overstates value. A good framework keeps growth, returns, and reinvestment logically connected. The framework also emphasizes long-term thinking. Short-term fluctuations may influence reported earnings, but intrinsic value depends on long-term sustainable performance. Temporary improvements do not create lasting value unless they change future cash flow permanently. Multiples such as price to earnings or enterprise value to earnings before interest and taxes are often used as quick references. Within a disciplined framework, multiples are not independent tools. They are simplified expressions of discounted cash flow. Behind every multiple lies an assumption about growth, risk, and return on capital. Understanding this connection prevents mechanical comparisons. For example, two companies may have identical earnings, but if one has higher return on invested capital and better growth prospects, its justified multiple should be higher. Without a framework, investors may treat both companies as equal. With a framework, differences become visible. Another key feature of valuation frameworks is scenario analysis. The future is uncertain. No forecast will be perfect. Instead of searching for precision, a good framework examines ranges of outcomes. What happens if growth slows? What happens if margins improve? What happens if the cost of capital changes? This approach builds resilience into decision-making. Valuation frameworks also discipline emotion. Markets can become optimistic or fearful. Prices can move quickly. But a structured model anchors judgment in economics rather than mood. It does not guarantee correct predictions, but it reduces impulsive decisions. There are alternative frameworks that complement discounted cash flow. Economic profit models measure value creation by calculating profit after charging for the cost of capital. Adjusted present value separates operating value from financing side effects. Real options analysis considers managerial flexibility in uncertain environments. Each of these methods shares a common foundation. They all connect value to future cash generation and risk. The choice of framework depends on purpose. For mergers and acquisitions, detailed discounted cash flow analysis may be required. For quick market comparisons, multiples may provide insight. For capital allocation within a company, economic profit measures may be most helpful. What matters is consistency and economic logic. A framework is powerful because it creates transparency. When assumptions are visible, they can be challenged and improved. When logic is explicit, errors become easier to detect. Without structure, hidden assumptions distort conclusions. Perhaps the most important lesson of this chapter is that valuation is not about complexity. It is about coherence. A simple, internally consistent model is better than a complicated one filled with contradictions. Clarity creates credibility. At the center of every sound framework lies a simple principle. Value equals the present value of future cash flows generated by operations. Those cash flows depend on growth, return on invested capital, and competitive advantage. Risk determines the rate at which we discount those cash flows. Everything connects. Strategy influences growth. Operations influence margins. Capital efficiency influences reinvestment needs. Risk influences investor expectations. The framework ties these elements together into one integrated view. When investors and managers adopt a disciplined valuation framework, conversations change. Debates shift from opinion to drivers. Instead of asking whether a stock feels expensive, they ask what assumptions justify the current price. Instead of celebrating revenue growth alone, they examine whether growth creates value. Frameworks do not remove uncertainty, but they provide structure within uncertainty. They transform valuation from speculation into analysis. As we move forward, this framework will guide every step. We will reorganize financial statements to reflect economic reality. We will analyze historical performance to understand value drivers. We will forecast future performance with disciplined assumptions. We will estimate continuing value and cost of capital with care. This chapter establishes the map. The next chapters will walk the path in detail. Valuation begins not with numbers, but with a clear and consistent framework for thinking about value. Chapter 11. Reorganizing the financial statements. Before we can value a company correctly, we must see it clearly. Financial statements are the starting point. They contain income statements, balance sheets, and cash flow statements. But in their reported form, they are designed for accounting compliance, not valuation clarity. Accounting follows rules. Valuation follows economic logic. The two are related, but they are not identical. If we use financial statements exactly as reported, we may mix operating performance with financing choices. That can distort our understanding of value creation. The first task in valuation is to reorganize the financial statements. This does not mean changing the facts. It means rearranging information so that the economic story becomes visible. The most important distinction is between operating activities and financing activities. Operating activities include producing goods, delivering services, managing costs, and investing in assets that generate revenue. Financing activities include borrowing money, issuing shares, and paying interest or dividends. Why is this separation important? Because operating performance shows how well the business creates value. Financing decisions show how that value is distributed and funded. If we mix them together, we cannot measure return on invested capital accurately. Start with the income statement. We focus on operating profit after tax. Interest expense is removed from operating analysis because it relates to financing, not operations. This allows us to measure performance independent of capital structure. Next comes the balance sheet. We separate operating assets from non-operating assets. Operating assets include working capital, property, equipment, and intangible assets used in the business. Non-operating assets may include excess cash or investments not required for core operations. On the liabilities side, we separate operating liabilities from debt and other financing obligations. Operating liabilities such as accounts, payable support daily business activity. Debt represents financing choice. Once this reorganization is complete, we can calculate invested capital. Invested capital represents the total funds invested in operations. It includes equity and debt used to finance operating assets. This figure becomes central to measuring return on invested capital. The cash flow statement must also be aligned with operating logic. We focus on free cash flow. Free cash flow represents the cash generated by operations after necessary investments to sustain growth. It is the cash available to all providers of capital. Reorganizing statements also requires adjustments. Some accounting items may distort economic reality. For example, one-time gains or losses should be removed to reflect sustainable performance. Provisions and reserves may need review to ensure they represent true economic obligations. Consistency is essential. All calculations must align with each other. Operating profit must relate to operating invested capital. Free cash flow must reflect changes in operating assets and liabilities. This process may appear technical, but its purpose is simple. We are trying to see how efficiently the company turns invested capital into operating profit and cash flow. Without reorganization, that relationship remains hidden. Clear structure leads to better insight. When statements are reorganized properly, patterns emerge. We can observe whether margins are stable. We can see whether capital intensity is rising. We can identify whether growth requires heavy reinvestment. Reorganization also improves comparability. Different companies may use different financing structures. By focusing on operating performance first, we can compare businesses more fairly. This step builds the foundation for everything that follows. If the financial base is unclear, forecasts will be weak. If invested capital is miscalculated, return metrics will mislead. If free cash flow is distorted, valuation results will be unreliable. Valuation is only as strong as its inputs. Reorganizing financial statements ensures that those inputs reflect economic truth rather than accounting form. With clear and consistent financial statements, we are ready for the next step. We can now analyze how the company has performed historically. Understanding past performance helps us forecast future performance. This leads directly into the next chapter. Analyzing performance. Chapter 12. Analyzing performance. Once financial statements are reorganized to reflect economic reality, the next step is understanding what they reveal. Numbers alone do not create insight. Insight comes from interpreting relationships between growth, profitability, and capital efficiency. Performance analysis answers a simple question. How effectively has this company created value in the past? The most important starting point is return on invested capital. This measure connects operating profit to the capital required to generate it. It shows how efficiently management uses resources. If return on invested capital consistently exceeds the cost of capital, the company is creating value. If it does not, growth may actually reduce value instead of increasing it. Return on invested capital can be broken into two main components: operating margin and capital turnover. Operating margin measures how much operating profit is generated from each unit of revenue. Capital turnover measures how much revenue is generated from each unit of invested capital. Together, they explain why return on invested capital is high or low. A company may have strong margins, but require heavy investment in assets. Another may operate with thin margins, but extremely efficient use of capital. Understanding this balance reveals the economic character of the business. Growth is the next major element of performance analysis. Revenue growth attracts attention, but it must be evaluated carefully. Growth consumes capital. If a company expands quickly but earns low returns on new investments, overall value can decline. High growth is valuable only when returns on new capital exceed the cost of capital. Analyzing historical growth helps identify patterns. Is growth stable or volatile? Does it come from price increases, volume expansion, or acquisitions? Each source carries different implications for sustainability. Margins also require deeper examination. Are improvements driven by operational efficiency or temporary cost reductions? Are margins higher than competitors because of competitive advantage or short-term conditions? Comparing performance over multiple years reduces the risk of drawing conclusions from unusual periods. Capital efficiency trends are equally important. Has the company become more efficient in using working capital? Has asset turnover improved? Has management invested wisely or accumulated underperforming assets? These questions reveal discipline in capital allocation. Another useful perspective is economic profit. Economic profit measures the amount of profit remaining after charging for the cost of capital. It highlights whether reported accounting profit truly represents value creation. Positive and growing economic profit signals strengthening competitive position. Performance analysis must also consider industry dynamics. Some industries naturally earn higher returns because of barriers to entry or strong differentiation. Others face intense competition that limits profitability. A company's performance should be viewed relative to its industry environment. Volatility is another dimension. Stable earnings and steady returns often signal durable business models. Highly volatile results may indicate exposure to economic cycles or unstable demand. Understanding volatility helps assess risk and sustainability. It is also important to identify one-time items or unusual events. Restructuring charges, asset sales, or extraordinary gains can distort trends. Removing these effects creates a clearer picture of recurring performance. Cash flow trends deserve special attention. A company may report strong earnings but weak cash generation. If working capital expands rapidly or capital expenditures remain high, free cash flow may lag behind profit. Sustainable value creation ultimately depends on cash. Performance analysis is not about predicting the future directly. It is about understanding the economic engine of the business. It reveals strengths that may persist and weaknesses that may require change. This process also builds credibility in forecasting. When analysts understand historical drivers, they can project future performance more realistically. Assumptions become grounded in evidence rather than optimism. Patterns often emerge during careful analysis. A company with steadily improving return on invested capital may possess strong management discipline. A company with declining margins may face rising competition or cost pressure. Recognizing these signals early strengthens valuation judgment. Performance must also be evaluated over an appropriate time horizon. Short periods can be misleading. Economic cycles, commodity prices, or temporary disruptions may distort results. Looking across several years provides perspective. Ultimately, analyzing performance connects numbers to strategy. High returns may reflect brand strength, cost leadership, innovation, or network effects. Weak returns may reflect poor positioning or inefficient operations. Understanding these links deepens confidence in valuation conclusions. This chapter emphasizes that valuation is not mechanical. It requires interpretation and thoughtful questioning. Performance analysis transforms reorganized financial statements into meaningful insight. By understanding how the company has created or destroyed value in the past, we prepare for the next step. We move from looking backward to looking forward. We begin forecasting performance. Chapter 13. Forecasting performance. After understanding how a company has performed in the past, the next step is looking ahead. Valuation depends on the future, not the past. Historical analysis builds foundation, but forecasting builds value. Forecasting is not about predicting the future perfectly. It is about forming disciplined expectations based on economic logic. Good forecasts are consistent, transparent, and connected to real business drivers. The first element of forecasting is revenue growth. Growth assumptions must reflect industry conditions, competitive position, and market opportunity. A company operating in a mature industry cannot grow rapidly forever. A company with strong competitive advantage may sustain higher growth for longer. The key is realism. Growth should also be broken into components. Volume growth reflects demand expansion. Price growth reflects pricing power and inflation. Acquisition growth reflects strategic expansion. Each source of growth has different implications for risk and sustainability. Next comes operating margin. Forecasting margin requires understanding cost structure. Are costs mostly fixed or variable? Will scale improve efficiency? Is competition likely to reduce pricing power? Margins cannot expand indefinitely without reason. Operating margin and revenue growth together determine operating profit. But profit alone is not enough. We must also forecast reinvestment needs. Reinvestment includes capital expenditures and working capital. If revenue grows, the company usually needs more assets. New factories, new technology, and larger inventories require funding. Ignoring reinvestment leads to overstated free cash flow. The link between growth and investment is critical. High growth often requires high reinvestment. If reinvestment earns strong returns, value increases. If returns decline, rapid growth can weaken performance. Return on invested capital becomes central in forecasting. We must estimate whether future returns will remain stable, improve, or decline. Competitive advantage determines this path. Strong brands, patents, or network effects may protect high returns. Intense competition may push returns downward over time. Forecasts should also reflect industry cycles. Some industries move with economic conditions. During expansion, margins and growth may rise. During recession, both may fall. A balanced forecast avoids assuming peak conditions will last forever. Another key principle is internal consistency. Revenue growth, margins, capital turnover, and reinvestment must align logically. If margins rise significantly, what operational improvements support that change? If growth accelerates, where does the demand come from? Every assumption must connect to business reality. Forecasts typically cover a defined explicit period. This period may span several years. During this time, growth gradually transitions toward a stable level. Eventually, the company reaches a mature phase with steady growth and stable returns. This transition is important. No company can grow faster than the economy forever. Sustainable long-term growth must align with broader economic expansion. Assuming perpetual high growth overstates value. Risk must also be considered while forecasting. Uncertainty increases as we look further into the future. Instead of relying on one scenario, it is wise to consider multiple possibilities. Base case, optimistic case, and conservative case provide range. This approach improves decision-making under uncertainty. Transparency is essential. Clear documentation of assumptions allows others to understand and challenge the forecast. Hidden optimism weakens credibility. Explicit reasoning strengthens confidence. Management guidance may provide useful input. However, forecasts should not rely blindly on management targets. Independent judgment ensures objectivity. Forecasting also requires awareness of structural change. Technological shifts, regulation, or changing consumer behavior can alter business models. Assumptions must adapt when environments evolve. Ultimately, forecasting translates strategy into numbers. If management plans expansion into new markets, forecasts must reflect expected revenue and investment. If cost reduction programs are underway, margin projections should incorporate realistic improvements. This chapter emphasizes that forecasting is both analytical and thoughtful. It combines quantitative reasoning with qualitative understanding. It requires humility about uncertainty and discipline about logic. When forecasts are complete, we have projected free cash flows for the explicit period. But most of a company's value often lies beyond that horizon. The next step is estimating continuing value, which captures performance far into the future. Chapter 14. Estimating continuing value. When forecasting performance, we usually project detailed cash flows for a limited number of years. This period may cover the time during which growth gradually slows and returns stabilize. But companies do not stop operating after that explicit forecast period. They continue generating cash long into the future. Capturing this remaining value is the purpose of continuing value. Continuing value often represents a large portion of total valuation. In many cases, it accounts for more than half of enterprise value. Because of this, small changes in assumptions about the distant future can significantly affect results. Care and discipline are essential. The core idea behind continuing value is stability. After a period of transition and growth, a company is assumed to enter a mature phase. In this phase, growth becomes steady and aligned with long-term economic expansion. Return on invested capital stabilizes at a sustainable level. Reinvestment supports ongoing operations without dramatic shifts. The most common method for estimating continuing value uses a perpetual growth framework. This approach assumes that free cash flow grows at a constant rate forever. That growth rate must be realistic and sustainable. No company can grow faster than the overall economy indefinitely. Choosing a modest long-term growth assumption protects against overstatement. The continuing value formula connects free cash flow, growth, and the cost of capital. If growth is higher, continuing value increases. If the cost of capital is higher, continuing value decreases. If free cash flow at the start of the stable period is stronger, value rises. These relationships highlight why disciplined forecasting matters. Another important method is the value driver formula. This approach links continuing value directly to return on invested capital and growth. It reinforces a central principle. Growth creates value only when return on invested capital exceeds the cost of capital. If returns equal the cost of capital, growth does not increase value. If returns fall below the cost of capital, growth reduces value. Because continuing value reflects long-term assumptions, consistency is crucial. If the explicit forecast period shows declining margins and competitive pressure, it would be unrealistic to assume high stable returns afterward. If capital intensity is rising, reinvestment needs must be reflected in stable growth assumptions. Terminal year numbers deserve special attention. The final year of explicit forecasts should represent a normalized state. Margins should reflect sustainable levels. Investment should reflect steady-state conditions. Using temporary peak performance as the base can distort continuing value. Another approach to estimating continuing value involves exit multiples. This method assumes the company could be sold at a market multiple at the end of the forecast period. While practical in some contexts, this method still depends on underlying cash flow expectations. Multiples themselves embed assumptions about growth and risk. Therefore, they should remain consistent with the broader discounted cash flow framework. Sensitivity analysis becomes especially important at this stage. Small variations in long-term growth or cost of capital can change valuation significantly. Testing different scenarios reveals how robust the valuation is to assumption changes. This improves confidence in decision-making. Continuing value estimation also requires humility. The distant future contains uncertainty. Instead of seeking precision, focus on reasonableness. Choose growth rates that reflect economic logic. Align returns with competitive realities. It is helpful to remember that continuing value does not mean infinite growth. It represents the value of stable, ongoing operations beyond the explicit forecast period. The emphasis shifts from rapid expansion to sustainable performance. Companies with strong competitive advantages may sustain returns above the cost of capital for longer periods. Companies in highly competitive industries may see returns gradually converge toward the cost of capital. Understanding industry structure guides these assumptions. At its core, continuing value reinforces the book's central message. Value depends on long-term cash generation and disciplined reinvestment. Short-term fluctuations matter less than sustainable economics. When continuing value is calculated and discounted back to present, it is added to the present value of explicit forecast cash flows. Together, they produce enterprise value. This represents the value of operations as a whole. But one essential piece remains. We must determine the rate at which future cash flows are discounted. That rate reflects risk and opportunity cost. It is known as the cost of capital. Understanding and estimating the cost of capital accurately becomes the next critical step in the valuation journey. Chapter 15. Estimating the cost of capital. Valuation is not only about estimating future cash flows, it is also about understanding risk. Two companies may generate similar cash flows, yet one may be worth less because its future is more uncertain. The cost of capital captures this idea. It represents the return investors require for providing capital to the company. The cost of capital reflects opportunity cost. Investors could place their money elsewhere in assets of similar risk. To attract funding, a company must offer a return that compensates for uncertainty. If the expected return is too low, investors will move their capital to better alternatives. In valuation, the cost of capital is used to discount future free cash flows. The higher the cost of capital, the lower the present value of those cash flows. This relationship reminds us that risk reduces value. The cost of capital has two primary components: the cost of equity and the cost of debt. Equity investors expect compensation for bearing business risk. Debt holders expect interest payments that reflect credit risk. The weighted average of these two components forms the weighted average cost of capital. The cost of equity is typically estimated using a model that links expected return to risk. The model begins with a risk-free rate. This represents the return available from an investment with minimal default risk. It then adds a market risk premium. The market risk premium represents the extra return investors demand for investing in the overall stock market instead of risk-free assets. The final element is a measure of how sensitive the company is to market movements. Companies whose earnings fluctuate more than the market are considered riskier. They require higher expected returns. This sensitivity measure connects company-specific risk to broader market risk. The cost of debt is generally easier to observe. It reflects the interest rate the company pays on its borrowings. However, because interest payments are tax-deductible in many jurisdictions, the effective cost of debt is adjusted for taxes. This adjustment recognizes the benefit of interest deductibility. Once the cost of equity and after-tax cost of debt are determined, they are weighted according to the company's capital structure. If a company uses more debt, debt carries more weight in the calculation. If equity dominates financing, the cost of equity has greater influence. Choosing appropriate weights is important. Market value weights are typically preferred over accounting book values. Market values reflect current investor expectations and risk perceptions. Estimating the cost of capital requires judgment. Risk-free rates change over time. Market risk premiums vary across markets and economic conditions. Company-specific risk measures may fluctuate. Because small changes in the cost of capital can significantly affect valuation, assumptions must be reasonable and consistent. Industry context matters. Companies in stable industries may have lower risk and lower cost of capital. Companies in volatile sectors may require higher expected returns. Geographic exposure can also influence risk. Operating in emerging markets may increase uncertainty and raise the cost of capital. It is also important to distinguish between systematic risk and company-specific risk. Systematic risk affects all companies and cannot be diversified away. Company-specific risk can often be reduced through diversification. The cost of equity focuses primarily on systematic risk because diversified investors are assumed to eliminate company-specific exposure. Another key principle is consistency. Cash flows must match the discount rate. If cash flows are projected in nominal terms, including inflation, the cost of capital must also reflect nominal rates. If cash flows are adjusted for risk directly, the discount rate should not double count that risk. While estimating the cost of capital may seem technical, its economic meaning is simple. It represents the minimum return required to justify investment. If a company earns returns above its cost of capital, value is created. If returns fall below it, value is destroyed. The cost of capital therefore acts as a bridge between performance and valuation. It translates risk into numbers. It connects expectations with reality. When the cost of capital is carefully estimated and applied consistently, we can discount projected free cash flows to present value. Adding the present value of explicit forecasts and continuing value gives enterprise value. From there, we move closer to the perspective most investors care about. How much is the equity worth? How much is each share worth? The next step takes us from enterprise value to value per share, completing the core valuation process. Chapter 16. Moving from enterprise value to value per share. After forecasting free cash flows and discounting them using the cost of capital, we arrive at enterprise value. Enterprise value represents the total value of the company's operations. It reflects the value available to all providers of capital, both debt and equity. But investors who buy shares are concerned with equity value. They want to know what belongs specifically to shareholders after all other claims are satisfied. Moving from enterprise value to value per share completes the core valuation process. The first step is understanding what enterprise value includes. Enterprise value captures the value of operating assets. It excludes non-operating assets and financing obligations. Therefore, adjustments are required before calculating equity value. To arrive at equity value, we begin with enterprise value. Then, we subtract net debt. Net debt equals total debt minus excess cash. Debt represents a claim that must be repaid before shareholders receive value. Excess cash, if not required for operations, belongs to equity holders and is therefore added back indirectly through this adjustment. In addition to debt, other non-equity claims must be considered. These may include unfunded pension obligations, minority interests, or other long-term liabilities. Each represents a claim on enterprise value that reduces what remains for shareholders. Minority interest arises when a company owns less than the entire stake in a subsidiary. If consolidated financial statements include 100% of the subsidiary's performance, but not all of it belongs to the parent, adjustments are needed. The value attributable to minority shareholders must be separated. Similarly, non-operating assets should be added after calculating enterprise value. These may include excess cash beyond operating needs, investments in unrelated businesses, or real estate not used in operations. Such assets increase equity value because they belong to shareholders. Once all adjustments are made, we obtain total equity value. To determine value per share, equity value is divided by the number of diluted shares outstanding. Dilution accounts for stock options, restricted shares, and convertible securities that may increase the share count. Ignoring dilution can overstate per share value. This process may appear mechanical, but each adjustment reflects economic logic. Enterprise value focuses on operations independent of financing. Equity value reflects what remains after satisfying all other claims. Accuracy in this stage requires careful attention to detail. Debt should be measured at market value when possible. Off-balance sheet obligations should be identified and included. Short-term and long-term borrowings must both be considered. The timing of shares outstanding also matters. Share repurchases or issuances can change ownership structure. Valuation must reflect the current share count, consistent with projected performance. Another important concept is reconciliation with market price. Once value per share is calculated, it can be compared with the current market price. If intrinsic value exceeds market price, the stock may be undervalued. If intrinsic value is below market price, expectations embedded in the market may be too optimistic. However, valuation is not about finding exact numbers. It is about understanding what assumptions justify the current price. By analyzing equity value per share, investors can identify which variables drive differences between intrinsic value and market price. Sensitivity analysis plays a useful role here. Changing growth rates, margins, or cost of capital will affect enterprise value and equity value. Observing how per share value responds to these changes deepens understanding of risk and opportunity. It is also helpful to examine implied expectations. If market price is significantly higher than intrinsic value based on conservative assumptions, it suggests investors expect stronger growth or higher returns than currently forecast. This insight shifts the conversation from price to performance expectations. Moving from enterprise value to value per share also highlights the impact of capital structure decisions. Increasing debt may reduce equity value if risk rises. Share repurchases may increase per share value if shares are bought below intrinsic value. These financial choices influence distribution of value, but do not create value unless operating performance improves. This chapter reinforces a central theme. Valuation begins with operations, but ends with shareholders. Understanding the full path from free cash flow to per share value ensures clarity at every stage. When enterprise value is carefully adjusted and divided by diluted shares, we obtain a measure that investors can compare directly with market prices. Yet valuation does not end here. After calculating per share value, we must analyze the results and interpret what they mean. The next chapter focuses on examining outcomes, testing assumptions, and drawing thoughtful conclusions from the valuation process. Chapter 17. Analyzing the results. After completing the valuation model and calculating value per share, many people feel finished. They see a final number and immediately compare it with the market price. But valuation does not end with a number. In fact, the most important thinking begins after the calculation is complete. Analyzing the results means understanding what drives the outcome. It means asking why the value is high or low. It means testing whether the assumptions are reasonable. The first step is identifying the main value drivers. Which variables have the greatest impact on enterprise value? Is value most sensitive to revenue growth? Does operating margin play a larger role? Is the cost of capital the most powerful influence? Recognizing these drivers shifts attention from outputs to inputs. Sensitivity analysis becomes a central tool. By adjusting one assumption at a time, we observe how value changes. If a small change in long-term growth dramatically alters valuation, that assumption requires careful scrutiny. If results remain stable across a range of assumptions, confidence increases. Another helpful approach is scenario analysis. Instead of changing one variable at a time, we create coherent scenarios. A conservative scenario may assume slower growth and stable margins. An optimistic scenario may assume stronger demand and efficiency improvements. Comparing scenarios reveals the range of possible outcomes. Analyzing results also involves comparing intrinsic value with market price. If intrinsic value is higher than market price, the market may be underestimating future performance. If intrinsic value is lower, the market may expect stronger growth or profitability than assumed. This comparison does not guarantee investment decisions, but it clarifies expectations. It is equally important to review the logic behind assumptions. Were growth forecasts consistent with industry trends? Were margin improvements supported by operational plans? Was reinvestment aligned with expansion expectations? Every number in the model reflects a story about the future. Analyzing results means evaluating the credibility of that story. Another useful perspective is reverse engineering the valuation. Instead of asking what the company is worth, we ask what performance is required to justify the current market price. This approach reveals embedded expectations. If the required growth appears unrealistic, caution may be warranted. If expectations seem conservative, opportunity may exist. Comparing valuation multiples implied by the model can also provide insight. For example, what price-to-earnings ratio does the intrinsic value suggest? How does that compare with industry averages? If the implied multiple appears extreme, assumptions may need review. Analyzing results should also consider qualitative factors. Does the company possess durable competitive advantages? Is management disciplined in capital allocation? Are industry dynamics stable or rapidly changing? Numbers alone cannot capture all dimensions of value. Communication is another part of analysis. When presenting valuation results to decision-makers, clarity matters. Explain key assumptions clearly. Highlight areas of uncertainty. Avoid presenting the valuation as precise or certain. Transparency builds trust and improves discussion. It is important to remember that valuation is a tool for decision-making, not prediction. The goal is not to forecast the exact future. The goal is to structure thinking about risk and return. A thoughtful analysis may reveal areas where further research is needed. Perhaps customer demand trends require deeper study. Perhaps competitive threats deserve more attention. Valuation can guide investigation rather than conclude it. This chapter emphasizes humility and discipline. Even the most detailed model rests on assumptions. Recognizing uncertainty prevents overconfidence. Testing assumptions strengthens credibility. When analysis is complete, valuation transforms from a static number into a dynamic framework for thinking. It helps managers allocate capital wisely. It helps investors evaluate opportunities rationally. It encourages decisions grounded in economics rather than emotion. Yet one additional perspective often complements discounted cash flow analysis. Multiples provide a quick way to compare companies and cross-check results. Used properly, they enhance understanding rather than replace disciplined valuation. The next chapter explores how to use multiples effectively and responsibly within a sound valuation framework. Chapter 18. Using multiples. After building a full discounted cash flow valuation, many analysts turn to multiples. Multiples are widely used in markets. They appear in headlines, analyst reports, and investment discussions. They offer a quick way to compare companies. But while multiples are simple in appearance, they require careful interpretation. A multiple expresses value relative to a financial measure. Common examples include price to earnings and enterprise value to earnings before interest and taxes. These ratios allow investors to compare companies of different sizes. Instead of focusing on absolute price, multiples focus on price relative to performance. The appeal of multiples lies in their simplicity. They are easy to calculate. They are easy to communicate. They provide a fast benchmark. However, simplicity can hide complexity. Behind every multiple lies an assumption about growth, profitability, risk, and return on capital. For example, a high price-to-earnings ratio often reflects expectations of strong future growth or high returns. A low multiple may signal slower growth, higher risk, or weak profitability. Without understanding these drivers, comparisons can mislead. Multiples should never replace discounted cash flow analysis. Instead, they should complement it. Discounted cash flow reveals intrinsic value based on explicit assumptions. Multiples provide a market-based perspective that reflects how similar companies are currently valued. Selecting the right multiple is important. For companies with stable earnings and moderate debt, price-to-earnings may be appropriate. For companies with varying capital structures, enterprise value-based multiples provide better comparability. Enterprise value neutralizes differences in debt levels, allowing focus on operating performance. It is also critical to compare companies with similar characteristics. Growth rates, margins, capital intensity, and risk profiles should align. Comparing a high-growth technology firm with a mature utility using the same multiple may lead to incorrect conclusions. Multiples are influenced by market conditions. During optimistic periods, market-wide multiples may expand. During uncertain times, they may contract. Understanding the broader market environment provides context. Another useful concept is the implied multiple from discounted cash flow valuation. Once intrinsic value is calculated, we can derive the corresponding price to earnings or enterprise value multiple. If the implied multiple differs significantly from market comparables, it signals that assumptions may differ. This comparison deepens insight. Multiples also require normalization. Temporary peaks or troughs in earnings can distort ratios. Using normalized earnings smooths out unusual effects and creates fairer comparisons. Cyclical industries particularly require careful normalization. Forward-looking multiples often provide better perspective than historical ones. Markets value companies based on expected future performance. Therefore, using forecasted earnings may better reflect expectations. However, forecasts must remain realistic. Multiples can also be used in transaction analysis. In mergers and acquisitions, transaction multiples reveal how much buyers have paid for similar companies. These benchmarks provide reference points, but must account for differences in timing and conditions. One risk in using multiples is circular reasoning. If analysts justify a high multiple simply because the market assigns it, they may overlook underlying fundamentals. Multiples should be interpreted through the lens of value drivers. A disciplined approach asks key questions. Why does this company deserve a higher multiple? Is growth sustainable? Are returns on invested capital strong? Is risk lower than peers? These questions anchor multiples in economics rather than fashion. Another consideration is capital structure impact. Companies with higher leverage may show different price-based multiples compared with enterprise value-based multiples. Understanding how debt influences valuation ratios ensures fair comparison. Multiples provide speed, but not depth. They offer perspective, but not complete explanation. When used alongside discounted cash flow, they strengthen confidence in valuation conclusions. This chapter highlights balance. Relying solely on complex models may overlook market signals. Relying solely on multiples may ignore intrinsic value logic. Combining both approaches creates a fuller picture. In practice, many professionals begin with discounted cash flow to establish intrinsic value. They then use multiples to cross-check results and assess market sentiment. When both methods align, confidence increases. When they diverge, further analysis is required. Ultimately, multiples remind us that valuation is both analytical and comparative. Companies do not exist in isolation. They operate within industries and markets. Understanding relative positioning enhances judgment. With multiples understood, The next step addresses situations where companies operate in multiple distinct businesses. In such cases, valuing the company as a single unit may hide important differences. This leads to the method known as valuation by parts. Chapter 19: Valuation by Parts. Many companies are not single businesses. They operate across different industries, geographies, or product lines. Each segment may have unique growth prospects, risk levels, and capital requirements. Valuing such a company as one uniform entity can hide important differences. Valuation by parts addresses this complexity. The core idea is simple. Instead of valuing the entire company using one set of assumptions, we value each business segment separately. Then we combine the individual values to determine total enterprise value. This approach often reveals insights that a single blended model cannot provide. Consider a company with two divisions. One division operates in a mature industry with stable cash flows. The other division is a high-growth digital platform with strong expansion potential. If we apply average growth and margin assumptions to the entire company, we may misrepresent both businesses. Valuation by parts allows each segment to be evaluated according to its own economic reality. The first step is identifying clearly defined operating segments. Financial disclosures often provide segment-level revenue and profit information. Each segment should be analyzed as if it were a standalone company. Revenue growth, operating margins, and capital intensity may differ significantly across segments. Next, we estimate free cash flows for each segment individually. This requires allocating invested capital appropriately. Shared assets and corporate overhead must be assigned carefully to avoid distortion. Consistency in allocation improves credibility. After forecasting segment cash flows, each segment is valued using discounted cash flow analysis. If segments operate in different industries or geographies, cost of capital may vary between them. Higher risk segments require higher discount rates. Applying a single cost of capital to all segments may misprice risk. Once enterprise value is calculated for each segment, the values are added together. Non-operating assets and corporate liabilities are then adjusted at the consolidated level. The final result reflects total enterprise value derived from individual business economics. Valuation by parts is especially useful when companies plan restructuring or divestitures. If one division consistently earns returns below the cost of capital, separating it may unlock value. If a high-growth segment is hidden within a larger mature company, standalone valuation may reveal greater worth. This method also helps investors understand conglomerates. Large diversified companies may trade at a discount because their complexity reduces transparency. Breaking the company into parts can clarify where value is created and where it is diluted. However, valuation by parts requires careful judgment. Segment-level financial data may be limited. Allocating shared costs can introduce subjectivity. Interdependencies between segments must be considered. For example, one division may support another through shared distribution or brand strength. Ignoring such connections may overstate standalone value. Synergies also matter. Some businesses benefit from operating together. Shared technology, procurement advantages, or customer relationships may enhance performance. Valuing segments entirely independently could overlook these benefits. Despite these challenges, valuation by parts offers powerful insight. It encourages analysts to look beyond aggregated numbers. It highlights differences in return on invested capital across segments. It reveals which businesses deserve more capital allocation. This approach reinforces a central principle of valuation. Value depends on economic performance, not size alone. A smaller segment with strong returns and growth may contribute more to intrinsic value than a larger but less efficient division. Valuation by parts also supports strategic decision-making. Management can evaluate whether to invest, restructure, or divest particular units. Capital can be redirected towards segments that create the most value. From an investor perspective, understanding segment economics improves interpretation of market price. If the sum of parts exceeds the current market value, the company may be undervalued. If certain segments destroy value, expectations may need adjustment. This chapter emphasizes clarity and granularity. Instead of treating the company as a single block, valuation by parts recognizes diversity within operations. It aligns analysis more closely with real-world complexity. With this chapter, the core valuation techniques are complete. We have moved from frameworks to financial reorganization, performance analysis, forecasting, continuing value, cost of capital, equity value, result interpretation, multiples, and segment valuation. The next part of the journey explores advanced valuation techniques. These topics address special accounting items, taxes, leases, and other complexities that influence value. Now, I'm going to wrap up this video here because this book has 5 parts, and covering all of them in one go would make it way too long. Don't worry though, the next part will be uploaded next week, so stay tuned. If you found this video helpful or interesting, make sure to subscribe, and if you haven't hit the like button yet, now's the perfect time. It's free for you, but it really helps the channel grow. Thanks for watching, and I'll see you soon. And if you're watching this video after a week, check the description for the link to the next part.